oil is up, and everyone has the same take. Inflation is back. Consumers are screwed. The Fed needs to act. And look, that take isn't wrong. It's just not the scary part. The scary part is what happens when an oil shock doesn't just raise prices. It breaks the entire mechanism that central banks use to fix things. And there's a reason you don't hear it talked about enough. Everybody loves a simple story. Oil up, bad. Fed hikes, done. But that framing misses the structural problem underneath. The one that made the 1970s a lost decade, and the one that's quietly setting up again right now. Here's the simplest way to think about stagflation. Normally, inflation and unemployment move in opposite directions. Prices rise, central banks hit the brakes, everything cools. It's uncomfortable, but manageable. Stagflation breaks that. You get high prices and a crumbling economy at the same time. And suddenly, every tool the Fed reaches for cuts in the wrong direction. Raise rates to fight inflation, you kill growth. Cut rates to save growth, inflation explodes. There is no good move. And as of March 2026, we have all four conditions for stagflation live, simultaneously, for the first time in decades. This isn't a what if. This is a what now. Meet Sarah. Sarah runs a small bakery. She doesn't trade oil futures. She doesn't own a refinery. She just makes bread. But when oil spikes, Sarah gets hit from every direction at once. The flour delivery costs more. The packaging costs more. The electricity to run her ovens costs more. And the customers walking through her door have less money in their pockets because everything else in their lives just got more expensive too. So Sarah raises her prices and sells less at the same time. That's not just Sarah's problem. That's the entire economy. Here's why oil is different from every other commodity. Oil isn't just fuel. It's the hidden cost inside everything. Shipping, manufacturing, agriculture. Every single thing that gets made, moved, or grown has oil embedded in its price. So when oil spikes, costs rise across every layer of the supply chain simultaneously. Companies raise prices, inflation goes up. But higher prices mean consumers have less real purchasing power. They spend less. Businesses see demand fall. They slow investment. They cut jobs. Growth drops. Follow the chain. Oil spikes leads to costs rise, leads to companies raise prices, leads to inflation goes up. And at the exact same time, real incomes fall, leads to spending drops, leads to growth slows. And it spreads further than most people realize. One commodity, every layer, no escape route. Welcome to stagflation. And Sarah's bakery, that's not a hypothetical. In 1973, it happened to an entire decade. Let's go back a bit. Most people know about 1973, OPEC embargo. Oil prices shot up, bad times. What most people don't know is what it actually felt like to be inside that economy, and more importantly, what it took to get out. October 1973. The Yom Kippur War breaks out. OPEC cuts off oil exports to the West. Prices don't creep up. They quadruple in months. Inflation hits double digits. Simultaneously, the economy falls into recession, and the Fed stares at two problems that its entire toolkit was not designed to solve at once. It's like being poisoned by two toxins simultaneously, where the antidote for one accelerates the other. The cure is the problem. That was the Fed's position. So, what did they eventually do? Paul Volcker took over as Fed chair in 1979, and he did something that nobody in modern central banking has done before or since. He raised interest rates to 20%. 20%. The logic was brutal. Make borrowing so expensive that the entire economy slams the brakes. Force the inflation out by sheer financial pain. And it worked. Inflation crashed from 14.8% to 2.5% within 3 years. But here's the part that doesn't make the highlight reel. Unemployment hit 10.8%, the worst since the Great Depression. Industries collapsed, the housing market froze, and the ripple effects hit the entire world. Countries across Latin America had borrowed heavily in US dollars, and suddenly their debt repayments became mathematically impossible. The Latin American debt crisis of the 1980s was, in large part, a consequence of Volcker's cure. So yes, Volcker fixed stagflation by causing a different global crisis. And here's the question nobody in traditional financial media is asking right now. Could the Fed do that again? No. Global debt in 2026 is orders of magnitude higher than 1980. A 20% interest rate today wouldn't just slow the economy. It would detonate the entire global debt structure before it finished the job. The only playbook that ever worked against stagflation is the one the Fed can no longer run. So here's the trap, in plain terms. Raise rates, you kill growth. Cut rates, inflation explodes. Do nothing, both get worse. Pick your poison. And here's what traditional financial media keeps missing. Everyone is hyperanalyzing the Fed's rate decision like it's going to tell us something new. But the real story isn't what the Fed decides to do. It's that there is no good decision to make. Now let's run the 4 conditions for stagflation against what's actually happening right now. Condition 1. Oil supply shock. Since the U.S.-Israeli strikes on Iran in late February, tanker traffic through the Strait of Hormuz dropped 70%. Brent is above $90. And if it stays 30% above pre-shock levels for more than 2 months, the macro damage starts compounding in ways that are very hard to reverse. We're on week 3. Condition 2. Sticky inflation. December 2025, CPI, 2.7%. Still above the Fed's 2% target, after years of elevated rates. At the last meeting, the Fed revised its inflation forecast up to 2.7%, while holding rates steady for the second straight meeting. Inflation going up. Tools staying put. That's the stagflation signal. Condition 3. Slowing growth. GDP in Q4 2025 came in at 0.7%, down from 4.4% in Q3, and on March 6th, non-farm payrolls fell by 92,000. Economists had expected a gain of 60,000, minus 92,000. Condition 4. The Fed is stuck. Last night, March 18th, 2026, the FOMC voted 11-1 to hold rates at 3.5 to 3.75%. And Powell said this.
If we were ever going to skip an SEP, this would be a good one because we just don't know.
Let me translate that. The Fed chair is telling you that their own economic projections are so uncertain right now that they almost didn't publish them. The most powerful central bank in the world is saying, we don't know what's coming. 4 conditions, all checked. So, here's what we know. Oil shocks don't just raise prices, they break the playbook. The mechanism is real. The history is documented. The conditions are live. And the fix that worked in 1980, the Volcker option, is off the table in 2026. So what's the plan? There are options. Accelerate renewables to reduce oil dependency. Provide targeted fiscal support to the most exposed households. Coordinate internationally, which is what the IEA is already doing. They released 411.9 million barrels in emergency reserves, the largest in history. That's 4 days of global consumption. These options are real, and they're not enough. Not if this goes on for months rather than weeks. The Fed is watching, waiting to see which problem gets worse, faster. That's not indecision. That's what it looks like when the playbook runs out. The number on the ticker isn't the story. The trap underneath it is. Most people aren't watching oil futures right now. They're watching their grocery bill, their electricity statement, the price of a tank of gas that somehow keeps creeping up even when they're not driving more. They're not making bad decisions. They're not spending recklessly. The numbers just don't add up the way they used to, and they can't quite explain why. That's stagflation in real life. Not a Fed statement, not a yield curve inversion, just the slow, invisible erosion of what the same paycheck can actually buy. Your salary didn't change. Your life quietly got smaller, and it's meaner than a normal recession, but it's not. Because at least in a recession, the system adjusts. Prices fall, rent drops. You lose something, but you also get relief somewhere. There's a logic to it. Stagflation has no such logic. The grocery bill goes up and the job market softens at the same time. There's no relief side, just the grind. So what do you actually do if you're not an investor? If you don't have a portfolio to rotate? You start with what you can see. Your fixed costs, rent, loan repayments, subscriptions, are your vulnerability. The things you can't cut quickly when things get tight. Map them. Know exactly where your floor is. That clarity alone is worth more than any financial prediction right now. Then your income. Not just how much, but how exposed it is. If your job sits inside discretionary spending, tourism, or anything tied to consumer confidence, you're closer to the front line than most people realize. That's not a reason to panic. It's a reason to know. And cash. In normal inflation, holding cash is a slow loss. It erodes by design. But a short-term buffer in a high-yield account or money market fund buys you something more valuable than returns right now. It buys you options. 3 to 6 months. Not paranoia. Just the ability to make decisions without being forced into them. None of this is exciting. But that's the point. Stagflation doesn't reward the most aggressive move. It punishes the most exposed position. Now zoom out. For anyone with a portfolio, the instinct is to reach for a checklist, rotate into commodities, add gold, trim duration. And historically, that's not wrong. Commodities, energy, tips, and companies with real pricing power have held up better in stagflation environments. The 60-40 portfolio breaks when bonds and equities fall together. In stagflation, they do. But the real edge isn't picking the right asset in March. It's not being forced to sell in April. Valuations compress fast and recovery is slow. The investor who survives stagflation best isn't the one who called the rotation. It's the one who still had options when everyone else was liquidating. Liquidity isn't the boring answer. In this environment, it's the only one. Now, will this actually become full stagflation? Honestly, nobody knows. Not the Fed, which almost didn't publish its own forecasts last night. Not the economists putting 35% odds on it. The conditions are checked. The trap is real. But whether the disruption lasts long enough to become structural, that's still open. What isn't open? The cost of being prepared is low. The cost of being caught flat-footed is not. The number on the oil price ticker isn't going to tell you when to move. Neither is the next Powell press conference. But the grocery bill might.